We weren't involved. In 1997, the company in Gladstone was in financial difficulty and was actually, we bought it out of receivership. So it did look as though it was going to close around the end of 96, 97, which would have been a tragedy. However, we took it over, and I'm still trying to work out why we took it over. It did have one aspect to us that we were keen on, and that was the sustainability aspect of it. We'd had interest in retailing, we'd had interest in wholesaling, and we thought that every time we took one more step, we thought that the blokes that were making the money were the next ones down the ladder. So we thought, well, this manufacturing must be pretty good. We'll kill it. I've finally worked out after 40 years in business that the only people that are making money or have got money is the government. The situation in 1993, there was about 30 employees. We were running one shift, and what we were doing was we were selling sticks or making sticks to demand. And you can imagine that because of the cyclical nature of the ice cream business, that is winter, summer, we were having to employ people for one shift, then ramp up to 2 shifts, then ramp up to 3 shifts, then go back down the scale again to 1 shift. And that was causing a lot of grief. At about that time, 1997, 98, we had also recognised that for us to remain a competitor in Australia, we actually had to compete with imports. So therefore, we had to start thinking about what's this global thing mean to us. About 50% of the capacity of our factory is absorbed in Australia, and if we were running at that level, we would be out of business tomorrow. The unit costs for us, as you could see, such a small, simple or apparently simple piece of commodity, and that's what we are, a commodity. We need volume, and we need to be able to compete with the rest of the globe, even if we weren't selling to overseas markets. Now, we've got something like 99% of the Australian market, so there's no growth for us in Australia domestically. That put pressure on us to start thinking about how are we going to reduce our unit costs to compete with places like China. Around 98, 2000, the China factor became a real problem for us. China went through, as you know, a period of expansion in their exporting in all parts of the world. And they do have timber resources, natural timber resources, and they are have been very rapidly depleting those resources. They make chopsticks and they make ice cream sticks and they make other products as well. And they can make them for a fraction of the price or cost that we can. In fact, something like half. Now, at that point in time, we were looking down the barrel at a very, very strong competitor coming into Australia. We then went to China and had a look around, and we, at that point in time, had to make a decision as to whether we would stay in Australia or whether we would go into China as a joint venture partner with somebody. So we had the advantage of some of the technology that we had in our heads, and we had the advantage over there of the cheap labour. When I got there, what I found, I thought, was something that was incomprehensible. The denuded forests, the landscape that had been left after the harvesting that was happening was something that we couldn't live with and couldn't work with. So we came back to Australia and said that made our decision. We have to try and make this work. The first thing we did was we had a look at a model on what we call flat chat production. Now, if you look that up in the dictionary, you'll find that flat chat is one level above capacity. So the only way that we could survive was to wring every piece of, every saleable item out of that plant we could, on the basis that we had 3 shifts running everybody came into work every day knowing they had a permanent job and that they knew what their targets were for that day. So the economy of scale and getting the unit cost down to compete with China, that was what had to happen. So at that point in time, here we are producing sticks at a great rate of knots. We then had to look at export markets to take those sticks. And there's nothing more productive than an export manager who owns the business, who's got a red-hot poker chasing him with a warehouse full of stock. And but we determined that that's what we had to do. It was try that or get out. Our first 4 containers we put into Hamburg in Germany, and those first 4 containers came back to Australia. They were rejected. We made some assumptions about quality that were in fact incorrect, and that is lesson number 1. Lesson number 1 is understand the quality and understand your customer and his perception of quality, because that's the person that sets the standards. We don't set the standards, our customers set the standards, and if we're going to do business with them, we have to meet those standards. We continued to do business with that company for something like 10 years after that tragic event, and the reason that we were able to do that was because we responded, and we responded positively, and we moved heaven and earth to make sure we got up to the standard that that customer wanted. We brought the containers back, it nearly broke us, and we started all over again. We went to the staff and we said there's only one way to build the business, and that is based on quality first. The volume will follow. If you produce volume without the quality, then it will go in the opposite direction eventually. That was our interpretation of it, and it was fairly obvious. The second lesson out of that was that we were able to build a relationship with the customer out of adversity. So I think basically our response was what the customer probably didn't expect. They'd probably been treated by exporting operations before. Certainly in China, if you've got a container that lands over here from China and you've got a problem with it, you've got a problem, and it's probably not a shared one. And the other thing was that by going to a level for export, I think it brought our whole company up a notch in our quality and our quality performance. Now, there's plenty of you saw there, qualifications or way that you can be qualified through ISOs and through global food standards and all these sorts of things, and they are just an essential part of the business. They have to happen. Now, once we got to that stage, we've gone from the point of view of struggling to get business to now having our plant at capacity. That factory runs now 24 hours a day, 5 days a week, and we can't get anything more out of it. So we are going to have to, we're at the crossroads again, and I can tell you now that the environment that we're in now is very concerning to me. I guess if we look at the benefits of exporting, the first thing that we had to do was achieve economy of scale. That was our driver. And we wouldn't have gone offshore if it hadn't been for that. So we needed to compete with the imports. We were able to do that, and we got business offshore. The next one was, I guess it does spread the risk a little bit in your business. It creates risks, but it does spread the risk. In Australia, you could imagine there's a couple of very big suppliers of ice cream. They're global international companies, Unilever and Nestle, and those companies have a very big proportion of the business in Australia. So if we were only producing to the Australian market, we would find that 50-odd% or more of our business was with 1 or 2 customers. Now that in itself has some risk management requirements. So by going offshore, you're actually developing markets and more customers and spreading the risk. It provides the ability to compete with imports, and it also helps you substantiate capital expenditure if you're going to actually have that need to expand the business. Right, the problems with exporting. The exchange rate variation, it's not the exchange rate by itself, but it's the exchange rate variation that can bring a lot of grief. Right now, take an example. When we went into the UK market, we went in at 0.4 of a British pound to $1 Australian dollar. The pound now in relation to the Australian dollar is up over 6, or well, it was probably a fraction higher than that, 6.4, 6.3. So when that customer is buying his product from us, he is now paying 50% more than he was when we kicked off. So we've got to have a very nice smile and a good story to be able to maintain that business. Now, that's not putting 1 extra cent in our pocket. That's an increase in his cost, but no increase in our cost, and that's what exchange rates do to you. On the other side of the channel, we have Europe and the euro. We started off our business in Europe at 0.6, 0.58 actually, and that, as you're aware now, is up over 8. So again, there's something like a 30 to 40% increase in their cost and no benefit to us. And we're struggling in Europe right now. We have got opportunities in Asia. Asia was predominantly China driven and still is, because the Chinese product can very easily come down into those markets of Philippines and Indonesia. But the one thing that's happening in China is that the timber availability is now being restricted by the government. And as we all know, in China, when something is edicted by government, it happens. A little bit of corruption on the edges, but it happens. So what's happened, if you go to China now, where I was going into places maybe 300 or 400 kilometres south of the border with Russia to look at ice cream factories and plants, the trees have been taken out of all of that area, and now you go to places within 50 odd kilometres of the Russian border, and there are tree logs coming in from over the Russian border. So the depletion has been very rapid. When you think of the size of China, it's hard to imagine that they could deplete the trees in most of their forests. But India went that way, and India has very, very few forests. So with the position in China now, it appears that you could actually see sometime in the future that we may sell ice cream sticks to China. Wouldn't that be a coup? The other thing about being in the global market is that we find that development of relationships in business is just one of the first things that people really do need to come to grips with and understand. It's no different export. In fact, it's probably more so. We've gone overseas, we travel, there's a lot of travelling involved, and that is hard work, it's not fun. But those relationships, developing those relationships, having a beer with the bloke, I've cited yesterday the example of dealing with my Pommy mates. If we've got an issue, he's on the phone, and we've just got to sort out the cricket before we get onto the ice cream stick business. and we'll send emails to one another about who's belting who up. And the same in Europe. And one thing I have to say, if we have an advantage at all in Australia, is that a lot of our export opportunities are with people who like doing business with Australians. So there is an edge there. You can be confident that as long as you are an honest individual yourself, you can be confident that the people that you're talking to really do have an affinity, and that's I have not had an exception to that yet. There was something else I had to tell you. Oh yes, I think if you're going to, who here is thinking about exporting or is exporting? Not many. Oh, well, that makes me redundant. I suppose the exporting part of this story is the basis of the story of the growth in Austicks, and you've seen what Austicks does, so there's no point in elaborating on that. Probably establishing close relationships and then understanding the translation. There are pitfalls in receiving emails or sending emails out and assuming that the translation will actually happen accurately or will get the message that you actually got. So you really need to be thinking about, am I talking to a Frenchman, or am I talking to a POM, or am I talking to an Italian? And then Asia, we have situations where I'm the only one in the company that can actually talk to Asians on the phone because the others can't understand what they're saying. And that's just experience. It's just practice and experience. And things are said, how they actually translate in their own mind to say something to you, and you then have to try and interpret what that actually really means. And it's interesting. And as much with the US as anywhere else, the US speak differently to us. So where you think you've got a problem with language, you'll be oversensitive to it. But when you go to places like the US, you think, well, I don't have to worry about language here, and you really fall into some traps. Where to in the future? Well, I've got to tell you that I think after 40 years of business experience, we are in the worst environment for small business and general business outside the mining industry that I have ever seen. It is an absolute diabolical situation. The Australian dollar is way overvalued in my opinion, which is good for any of you who are importing. The escalating costs of our power, labour, the capabilities of our labour. Our reward for getting up and doing something, employing more people, is the tax. It's a penalty on, they call it payroll tax. So they penalise us for actually doing too much. Whereas in China, when they wanted to increase their exports, they were paying a rebate of 13.5% per invoice to help give them a leg up. How silly are we? And the uncertainty of the carbon tax. I can't stress too much, and this is not a political statement, this is a fact. Nobody can tell you what the carbon tax flow-through costs are going to be to us as individuals and to businesses. So, would I invest right now in exporting, or would I, and that's the thing we're struggling with. For us to increase our business, and we believe there is opportunity out there to sell, but there's no room for increase in our market in Australia, so every stick will have to go offshore. Under the present environment, it's a very, very high risk. Thanks.